Americans are lacking in financial education. People don't know how to save. Did you know that an average American has about 4 credit cards? People rely on benefits and social security and pensions, but millennials won't even have social security in the future when they will retire. The whole world is divided into 2 different groups: people who make less than $100,000 a year, which is 90% of the population, and people who make more than $100,000 a year, which is about 10% of the population. When you get your first paycheck, the first thing you've done is you probably opened a bank account. That's why 90% of the population associate their money with bank. So they put their cash into checking, savings, and CDs, making 0 to 3% a year. Now it's probably closer to 0. On the other hand, we have people who invest their money into mutual funds, real estate, and insurance, making 4 to 12% a year. And me and my friends, we're working with big companies such as Nationwide, National Western, AIG, or Mutual of Omaha. Your money can grow into 3 different ways: fixed, variable, and indexed. Fixed account is basically your savings account, where you start at a certain amount and you grow, let's say 3-4% a year for 35 years. In most of the cases, you don't grow 3-4% anymore. You grow, like I said, only 0.1% a year. Using Rule 72, we can estimate that it will take hundreds of years for your money to double. There's a second way to grow your money, and it's a variable way. Yes, your money can grow fast, 30-40% a year, but you also have a risk of economy crashing, and you can lose 40-50% of your account just in a year. So that's what happened in 2000 when Y2K happened. People just took their money from the dot-com companies. Then in 9/11 happened in 2001. Later on, the market went up, and in 2008 we had economic crash again. By the way, right now we are expecting another market correction in the next 12 months. There is a third way to grow your money, and it's through the indexed market. Your money is growing at the 85% of the variable markets. However, when the market crashes, when the market goes down, you stay at 0, or in some cases you're actually making 4% a year when everybody is losing money. Eventually, after all the economy crashes and after all these changes in the markets, into the stock markets, you end up much higher than people who invested their money in the fixed market or even variable markets. Most of the retirement accounts are invested in IRAs, and IRAs are invested straight into the market. So you are actually into the variable line when you are saving for your retirement through 401k or 403b or similar accounts. Well, the problem is you can lose your money when the market goes down. Yes, you can make more money when the market is going up. So the problem with these accounts is if you're retiring and you're younger than 59 and a half, you might withdraw money from your 401k. However, you will be taxed and you will have a 10% fee on your account if you're trying to get money earlier than you're supposed to. Yes, you might be working and you'll decide you'll work until you're 72 without touching your retirement savings. There is another law where government says, hey, if you want to take your money from your 401k until the age 70 and a half, we are taking 50% of your savings. So let's say you had $1 million saved for your retirement, you are turning 70 and a half, you only have $500,000 in your account, which is pretty bad because Uncle Sam wants its money. Most of the people keep their retirement savings in 401ks, 403bs, or IRAs, which is invested in variable markets and causes certain problems. One of the problems is you are getting taxed, and you're getting taxed heavily. For example, you'll decide to withdraw money from your 401k before you are 59 and a half. So the government taxes you, and on top of that, it will take a 10% fee from your account. But if you'll decide to work too long and you won't withdraw money from your 401k, then the government will take 50% of your savings into taxes, which is about $500,000 if you had $1 million in your account. That is why we're recommending indexed accounts. By transferring your money to those accounts, you're minimizing risks, getting tax advantages, and also you have a possibility of getting income until the end of your life. Life insurance is a great way to protect your family in your future. While death benefit can protect your relatives in case something happens to you, you still can use life insurance as a source of additional retirement income. Time is money. If you would like to save $1 million for your retirement and you're 25 years old, it would cost you about $280 a month in order to reach your goal. But if you're 45 years old, it might take you about $1,700 a month, which is basically a cost of mortgage. So don't wait these 20 years and start saving for your retirement right now, and we can tell you how. If you are interested in our life insurance products or our annuity products, you have school debt or medical debt, or you're getting a lot of speeding tickets and you just need a lawyer anytime you want it for low cost, please fill out the form below. We don't charge any fees for our consultation.